Welcome back. Stocks are higher in early trading, as you can see. Certainly the U.S. stocks markets indices are higher. The S&P 500 up by almost a full percentage point. The NASDAQ composite up by almost 2%. Is this the beginning, what we've seen since early April, the beginning of a new bull market? Our next guest is not convinced that the answer to that question is yes. Victoria Fernandez is Chief Market Strategist at Crossmark Global Investments. Victoria, thank you very much for joining us. You've said in some recent commentary you don't think that we're in the early stages of a new bull market. What do you need to see to be more constructive on stock markets?
Yeah, Paul, it took us a little bit of time to see those signals that told us we were probably at a low, and those finally came to fruition. But now we're looking at those signals that tell us can be sustainable. So one, we need to see a thrust in the breadth of the market, and we're not seeing that. Typically, you want to see 10-day averages moving higher. We haven't seen that yet. We've had a day or two of it, and then it pulls back. Secondly, you want to see the internal momentum of the market really take hold. So you're thinking of, number of stocks making 20-day highs, how many stocks are actually above their 20-day moving average. Again, these are not at levels we want to see. And our third item we really want to see is a change in the leadership of the market. That we haven't seen either. You still have utilities and financials really with the strongest uptrends in the market. These are the areas that continue to do well. Discretionary versus staples on a relative basis, that continues to come down. So we haven't seen the change in the leadership of the market to tell us this is sustainable. We could be getting close, but we're not there yet. So we'll continue to watch for those elements.
You've also said recently we will need a strong earnings season to support the equity market, and I'm not sure we will get that. And now we're fairly deep into earnings season. What are you seeing in earnings?
Yeah, well, we look at yesterday, obviously Microsoft and Meta are going to help the earnings season numbers pretty significantly. We'll see what happens today with Apple and Amazon. Those tech names really have a huge impact on the overall earnings. So they could really drive it forward. Prior to some of these big tech names, we had been seeing pretty weak earnings. And we look at the guidance coming out of a lot of these companies, and either they're pulling guidance or they're lowering their guidance. We've seen it from GM, we've seen it from McDonald's, just a couple of the names over the last couple days, but there's a lot of uncertainty in regards to the guidance, and that is kind of pulling sentiment down both on the consumer side and on the business side. So we'll see where we end up. Earnings, I think, are a little bit stronger than people anticipated because of the solid numbers out of the tech names. But underneath that, we're still pretty weak.
You think this is the right kind of environment for investors to sell some of their winners, or at least a portion of their winning positions, and look to redeploy those proceeds elsewhere? What would you be looking for in this environment to buy?
Yeah, so go in, and if you've had staples and had a more defensive posture in your portfolio, which is what we've been doing for our clients, go in and trim some of those names. Coca-Cola is a perfect example of a name that we were trimming a couple of weeks ago when it had such a nice run higher, anticipating that we would start to see some of the more cyclical names come into play. But I think you still have to look in sectors that have uptrends. So look at the financial names. Progressive is a name that we really like on the financial side. Look at maybe some healthcare names like a Gilead, and you can still find other areas where the sector's not doing well, but individual stocks will. So like in tech, we think look at Cisco for a longer term holding in your portfolio. These are some examples of trimming some of those staple names and going into some areas that have some good growth potential.
How do you interpret the huge profit warning from General Motors today? How does it apply to other companies in the industrial sector, not just in the automotive sector, but more broadly among peer group companies in the U.S.?
Right. Mary Barra said, what, $4 to $5 million hit probably from tariffs. And when you look at the industrial sector, you have to think short term and long term. Short term, there's going to be some headwinds, obviously, from the tariffs. They can't change their supply chains overnight. Some industrial companies actually started moving those back during COVID. So maybe they're in a little bit of a better position. Newell Brands, for example, is saying they moved their supply chains back to the U.S. So they actually are at an advantage advantage during this point in time. But longer term, if we do have the reshoring to the United States, if you have more companies building here, if we're building out AI infrastructure, longer term industrials can do better. So you have to kind of look, short term could be a rough ride, but longer term, if you can go in and buy some of these names on pullbacks, I think they could do well for you over the next couple of years.
Victoria, thank you so much for joining us. Victoria Fernandez is Chief Market Strategist at Crossmark Global Investments.